Today, US inflation is hanging around like a bad smell. Hi again, it's Martin North from Digital Finance Analytics with the latest post, covering funds and properties with a distinctively Australian flavour. Well, the latest data shows that while US inflation fell for a 7th consecutive month, it came in ahead of analysts' expectations. Consumer prices rose 0.5% in January, that's the most in 3 months, bolstered by gasoline and shelter costs. That was in line with economists' expectations, but marked the biggest increase in 3 months. And the annual inflation rate came in at a higher than expected 6.4%, and still far above the Fed's goal of 2% annual inflation, which, by the way, is based on a separate measure. In some key categories, from energy to various goods, such as clothing, the slowdown in costs that was a feature of the final months of 2022 looks to have stalled out or even reversed. What's more, the January numbers follow revisions to last year's data that already tempered the narrative of how much inflation is actually easing. Looking at the moving parts, shelter remains sticky. Inflation has already come down from a peak above 9% last year, the highest in 4 decades. Analysts who expect the slide to resume in the coming months point to the housing market, because housing costs were by far the biggest contributor to the monthly increase in the consumer price index, accounted for almost half of it. But because of the way these numbers are calculated, there's typically a significant lag for real-time market conditions, which suggest the pandemic housing boom is over, show up in the government's inflation figures. Shelter CPI rose 7.9% year on year, making the highest rate of housing inflation since 1982. Shelter CPI lags behind actual prices due to the way it's reported. In previous years, it's significantly understated actual housing inflation, but now it's the opposite. For perspective, Shelter CPI is up 14.9% since the start of 2020. However, actual rents are up 20.3% and home prices are up 40%, so there's a bit of a catch-up to do. One thing that Fed officials say they're watching closely is the costs of services excluding housing and energy, a broad grouping that covers everything from haircuts to gym memberships. Wages are thought to be a key driver of prices in the category, and Americans have been spending more of their monthly budgets on services after a goods buying boom during the pandemic. One measure of services prices that strips out housing eased slightly from the prior month, though the slowdown was largely driven by a sharp drop in medical costs. Turning to the core CPI, rents account for 40% of core CPI and are running at around 9% annualised. The other 6% of core CPI is much softer at 1.5% annualised. This signals that the non-rent part of core does look to have normalised. So all of this shows how price pressures risk getting entrenched in the world's biggest economy, the outcome that the Federal Reserve is battling to prevent. And with an unexpectedly strong job market in early 2023, there's a growing likelihood that the central bank will keep hiking interest rates deeper into the year to cool things down. After the CPI data was announced, Fed funds futures are now pricing an upper bound terminal rate of 5.5%. That's up from 5.25%. The current upper bound is 4.5%. But that said, the first cut is also expected to take place in December by 25 basis points. Inflation is not going away quietly, wrote Wells Fargo economists Sarah House and Michael Pugliese. Getting back to an inflation rate the Fed can live with on a sustained basis will neither be quick nor painless. Details of January's CPI that were different from our forecast leaves us more confident that upcoming inflation prints will remain strong, even as shelter prices eventually start to moderate. Rebounds in components like used cars and airfares present upside risks. Others, though, are more sanguine, like ING Economics. We remain optimistic that inflation can get close to 2% late in 2023, largely through flat to lower prices for shelter and a squeeze on corporate profit margins, they said. Inflation stickiness could be seen in egg prices, which rose 8.5% in January, and in record high monthly payments for a new car. Yet equity bulls clung to one CPI component that Federal Reserve Chair Jerome Powell has signalled out as a must-watch, the so-called super core figure, or core services minus housing, came in at a slower 0.3 pace in the month. Bulls will point to the fact that the big driver remains shelter, which could start to come down quickly in the second half of the year. Chris Senick of Wolf Research wrote, bears will point to used car prices and other items that have driven recent disinflation starting to turn back. But Win Thin, currency strategist at Brown Brothers Harriman, wasn't buying the super core argument. If the market and the Fed have got to get this granular to somehow weave an inflation argument, then they've lost the argument, he said. Core inflation? Come on, man. Federal Reserve officials stressed the need for further interest rate increases to help tame inflation, but expressed differing views about how close they are to stopping after new data showed signs of persistent price pressures. Two officials said on Tuesday that interest rates may need to move to a higher level than anticipated to ensure inflation continues to ease. Richmond Fed President Thomas Barkin said that if inflation persists at levels well above a target, maybe we'll have to do more. And Dallas Fed President Lori Logan said we must remain prepared to continue rate increases for a longer period than previously anticipated if such a path is necessary to respond to changes in the economic outlook or to offset any undesired easing in conditions. They both commented shortly after data showed that the consumer prices climbed 6.4%, as discussed. Philadelphia Fed President Patrick Harker, speaking later in the day, said he believes policymakers will need to raise interest rates above 5% and possibly higher to counter inflation that is easing only slowly. We're going to have to let the data dictate that, he said in answering questions from an audience at LaSalle University. It's going to be above 5% in the Fed fund rate. How much above 5% is going to depend on what we're seeing. And New York Fed President John Williams said on Tuesday afternoon that subdued economic growth and labour market weakness will likely be required to bring inflation back down to the Fed's 2% target. I'm confident that the gears of monetary policy will continue to move in a way that will bring inflation down to 2%, Williams said in a speech at the New York Bankers Association. We will stay the course until our job is done. While all Fed officials participate in meetings of the Fed's Policy Committee, Logan and Harker are voting members this year and Barkin is not. Williams, as New York Fed President, is a permanent voting member, along with the Fed's 7 governors. At the start of February, they lifted their benchmark lending rate by 0.25 of a percentage point to a range of 4.5 to 4.75%. That followed a half-point increase at the December meeting, which came after 4 consecutive jumbo-sized 75 basis point hikes. Now, officials in December penciled in a peak interest rate of about 5.1% this year based on the median forecast. That's implying 2 more quarter-point increases, and Williams last week said those projections still offered a reasonable view of what the Fed will do this year to balance supply and demand and cool inflation. Expectations for where interest rates will peak have risen following stronger than expected jobs figures and continued signs of persistently high prices. Policymakers have been particularly worried by increases in services prices, driven in part by a shortage of workers, exacerbated by the COVID-19 pandemic. Fed Chair Jerome Powell has cautioned that an easing in a too tight labour market will be needed to cool continuing price pressures. Non-farm payrolls increased 517,000 last month. That's way more than expected. And the unemployment rate dropped to 3.4%, the lowest since May 1969. Now, there are some indications that economic growth could be more resilient than expected or even accelerate. The Atlanta Fed's tracker has put an early estimate of first quarter gross domestic product growth of 2.2%. That's analysed as of February the 8th. The Fed funds futures are now pricing an upper terminal rate of 5.5%, and the US 2-year Treasury jumped to a 4-month high. And there were some interesting perspectives about recent tech layoffs. Anticipating tighter money, Treasury bonds retreated after the initial inflation report, with 2-year yields climbing to the highest since early November. Traders stepped up bets that the Fed will hike rates 3 times more by the end of June. Economists at Barclays and Monetary Policy Analytics now see the Fed lifting rates to a range of 5.25 to 5.5, and the higher forecast reflects our view that the Fed will need to see material slowing in labour market outcomes to convince itself that wages are in course to return to rates of increase consistent with 2% inflation, and that such evidence will not be evident until the middle of the year. Swaps contracts showed investors now give near even odds of a quarter-point increase by the Fed in June, following similar hikes in March and May. The rate-sensitive 2-year Treasury yield rose past 4.6%. It surged this month, driven by a blowout jobs report and Fed officials making it clear that they intend to push rates towards 5%. As Federal Reserve Bank of Philadelphia President Patrick Harker said in a speech that policymakers were nearing the point where rates were restrictive enough. In my view, we're not yet done, but we are likely close. But others disagree. I don't think we're going to have a soft landing. I think we're going to have a soft, but not the landing. Ken Rogroff, a Harvard University professor and former IMF chief economist, said, now, the way Fed policymakers are thinking about inflation is that it all emanates from the labour market, which they describe as too hot for their liking. And more significantly, economists at the central bank believe the so-called neutral rate of unemployment, the rate at which the economy is now headed for recession or overheating, has moved up from 4% to somewhere between 5 and 6%. For the Fed, that's a big problem because the unemployment rate dropped to 3.4% in January, the lowest in 53 years. In reality, the decline in the unemployment rate shouldn't be a problem for the Fed. Evidence continues to mount suggesting that a low jobless rate has little to do with wage growth and household expectations of future earnings, two primary drivers of inflation. Just this week, a monthly survey released by the Federal Reserve Bank of New York showed that the consumer's outlook for inflation fell to the lowest since October 2020. So is the Fed making two mistakes in real time? The first is that policymakers assume the massive labour market disruption associated with the pandemic would make it difficult for employers to find employees that are good fits for specific roles and vice versa. When the economy opened, poor matching typically leads to higher unemployment. What they didn't and probably couldn't account for was how labour market matching would be affected by the unprecedented surge in household savings. Now, anecdotal evidence and a report by Federal Reserve Bank of Minneapolis senior research economist Simon Monge suggests that households use the extraordinary savings buffer to help them find better employment rather than settling for the first job that came along. Monge estimates that there was essentially no net deterioration in matching efficiency as a result of the pandemic. That would imply the natural rate of unemployment is close to where it was in January 2020, when the US enjoyed a 3.5% unemployment rate. Monge's conclusion is backed up by unit labour costs, which are rising at a slower rate. And the government said earlier this month that unit labour costs rose at 1.1% in the fourth quarter, below its long-term average of 1.8%. And year-over-year growth in average hourly earnings likewise continued to decelerate from 5.9% in March 2022 to 4.4% last month. And yet, Fed Chair Jerome Powell recently pointed out how the natural rate of unemployment had moved up materially, a view that helps explain why the central bank has been so aggressive in raising rates and is expected to keep them elevated for some time. The second mistake the Fed is making is ignoring what economists call hysteresis. In short, hysteresis suggests that sudden increases in the inflation rate can lower the natural rate of unemployment. The logic here is that when demand is high, employers alter their recruitment and retention practices and are slow to backtrack. This runs the gamut from investments in sophisticated human resources strategies to something as simple as labour hoarding. Over time, the effect of such changes should weaken as employers continually adjust to changes in both the labour market and the demand for their products. Right now, however, it suggests that 3.4% unemployment is not nearly as tight as it seems. And again, consider the New York Fed survey, which showed household expectations of income growth dropped by a record 1.3 percentage points from 4.6 to 3.3. Could wages and incomes really be slowing dramatically with unemployment at record lows? The short answer is, well, yes, it could be. And that means that the Fed needs to be more cautious about continuing to raise rates. The prudent step for the Fed, perhaps, would be to pause its rate hike cycle until the full measure of its effect on the labour market can be determined. But given the way they're thinking about it at the moment, and of course the Reserve Bank is doing the same, I think we have to bet on higher rates and quite soon. This is going to put a lot of pain to a lot of people, break a lot of businesses, and the question is it all really necessary? I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.